Welcome to Cross-Border Tax Talks, where we discuss the latest trends in international taxation, from U.S. tax reform to the OECD's latest developments. I'm Doug McHoney, PwC's U.S. International Tax Services leader. You can follow me on Twitter at XBorderTax. This week, we're still at hashtag WFH Podcast Studio. That's work from home for the social media challenged, where I'm excited to be joined by PwC's international tax partner, Neil Edwards. Neil is an international tax partner loosely based in our Chicago office, where he's part of our national integrated global structuring team. Neil is on secondment from our London office and has now lived through two major international tax reforms, one in the UK and one in the US. So Neil, welcome back to the podcast.
Thanks, Doug.
So on April 7th, Neil, Treasury released finalized regulations under 267 Cap A, our anti-hybrid rules, 1503D, our dual consolidated loss rules, and issued newly proposed regulations under Section 881, our anti-conduit rules. Before we dive into some of the specifics on the reg package, can you remind our listeners what those code sections relate to and broadly what this reg package did for taxpayers?
Sure, Doug. So first of all, let's start with 267 Cap A, the anti-hybrid rules. This is a new provision that was introduced in TCJA that really follows on from the OECD's work on hybrids and the Action 2 paper. What it's intended to do is deny deductions in the US for interest and royalty payments to the extent that income is not included in the recipient directly or indirectly as a result of some kind of hybrid treatment between the US and some other country. So that really is the kind of core anti-hybrid rule that was part of the BEPS proposal. The DCL rules are what you might see as kind of complementary to those rules. In the OECD was looking to target both deduction with no inclusion outcomes, as they called them, and double deductions. Now, we in the US already had double deduction rules and DCL rules, and they're really just kind of looking to fortify those rules. What they do is make sure that if there is, as a result, essentially of a hybrid entity, the US claiming a deduction together with another territory, then that deduction is potentially disallowed, so you don't get the same deduction twice. And then the anti-conduit rules are a part of a set of rules just around protecting the withholding tax base, and you could view again as almost a kind of not quite anti-treaty shopping, but similar approach in that if companies were to seek to route interest payments that would otherwise be due to a bad jurisdiction through a good treaty jurisdiction, then in some cases, if those rules apply, that payment can be viewed as being made essentially directly to the bad jurisdiction, and so subject to higher US withholding taxes. So these rules are already all part of a package aimed to protect the US tax base from foreign base erosion in what is considered to be inappropriate circumstances.
Excellent summary, Neil. We've spent a lot of time on cross-border tax talks talking about the OECD's BEPS initiative as well as BEPS 2.0 and even some specific countries. I think you even came on and talked about some of the UK anti-hybrid rules. Can you talk a little bit, give us a little bit of context, particularly given your experience in the UK for most of your career? How do the rules in the US broadly compare to what the OECD recommended in what is now referred to as BEPS 1.0? And then maybe we can also talk a little bit about, it seems like each jurisdiction has their own twist on these rules. And we've seen different rules in the UK and Australia and the US, all different flavors. But broadly, how do these compare?
So I'd say they're pretty similar in that they were all based off the same kind of fundamental discussion paper and idea. The concept with this paper was these rules were designed to be consistent territory by territory. I think what we've seen as individual territories, including the US, have actually implemented these rules, there are some key differences, right? The philosophies are similar, but when they actually bring them into practice, they differ. So, for example, Many of the OECD and other countries have said that these rules apply to all outbound payments from their territory, whereas the US rule is focused only on interest and royalties. So things like cost of goods sold payments, even if there's a economically embedded royalty, they're not within scope of the US rules. But conversely, certain other arrangements that, for example, where there are companies lending to the US or with royalties to the US that might benefit from notional interest deductions under their local regime, that sort of arrangement was specifically considered by the OECD and was not thought of as a hybrid arrangement. But the US rules have actually now decided to include that. So there's boundary differences in many of these approaches, which makes it really hard for taxpayers because if they've got a global structure where they've got consistent arrangements between territories, the rules that are supposed to be consistently applied to them and not always giving the same outcome.
Yeah, I think that's a real challenge for taxpayers, and we've seen it where the UK has really led the way in the anti-hybrid rules. Really, the first jurisdiction to put out those regs or to put out those rules, and then we've seen a number of other territories that were required as part of the EU anti-tax avoidance directive. And frankly, we're still waiting on a number of jurisdictions' final rules that, or even in Europe, that were part of ATAD 2. And then the US has jumped on. Any interesting comparisons, Neil, specifically with the UK rules or even Australia that might be worth highlighting for listeners?
So I'd say there's probably two or three things, and they're all again a little bit specific. So one of the big changes we saw as the final regs came out in the US, and there was a lot of discussion about this throughout the proposed regs, is how these rules apply to interest-free loans, where there may be arrangements between two different countries, one of which didn't apply transfer pricing rules. Again, that type of arrangement was explicitly contemplated by the OECD and said not to be within scope. And typically, like the UK has followed that approach, and there's an example in the UK guidance that says that's not within scope. The US has gone a different way there. There are other territories that have stretched the approach. And so if you look at like the Australian rule, they've included what they call like an integrity rule that is really not designed to deal with hybridity at all. It's designed to deal with low taxation, which is really a theme of BEPS 2.0 rather than 1.0. But in certain situations, they've said, even if you take away the hybridity, if you're still subject to a low rate of tax, this integrity rule comes in place. So they've kind of extended it in one direction that other territories haven't gone. And then I'd say maybe the other big piece that's interesting and I think different territory by territory is what's called an imported mismatch rule, which is where the payment, say the US is making to the foreign territory is not subject to hybridity, but then there's a further payment going out of that foreign territory to another territory which is hybrid. Many countries have, including the UK, for example, have adopted a rule where they would look to kind of tax that arrangement and seek to apply their hybrid rules if the second payment, the imported one, is somehow connected to the first payment. It was part of the same series of transactions or funding or something similar. Whereas the US approach has gone much broader and can still deny the US deduction, even though the imported payment is really from a totally unrelated set of funding arrangements and so on. So there's, again, there's a number of different kind of scoping and defining characteristics where these rules do differ importantly from case by case.
I think this is just a harbinger of things to come as we think about BEPS 2.0. And I know one of the goals of the OECD through these types of analysis is to be able to create consistent rules. And while the fundamentals are largely consistent, how they operate can be very different and obviously very challenging for corporate taxpayers that operate in a number of these developed countries.
I think that is, if you look at this rule from our perspective, is essentially an inbound rule, right? It in most cases only applies to US multinationals foreign multinationals with US subsidiaries. And I think that's what's making it even harder for, global tax directors and so on that are looking at this from a parent perspective, and they're used to seeing, one rule that's already been applied in Europe, and another rule that was applied in the UK before that, and another one in Australia. There's just some real surprises coming out when they kind of think they now understand what these hybrid rules are supposed to be catching, and then maybe the US rules just head in slightly different directions on some points, and it really does end up being difficult to follow with the differences by jurisdiction.
Okay, so let's dive into the regulation package, the final regs, and we'll spend a little time at the end on the proposed anti-conduit rules. But the final regs had a number of different changes. And to remind the listeners, the cross-border tax talks, there were kind of, I think, 5 categories, broad categories that apply to interest and royalty payments by U.S. companies. And thought, Neil, we could walk through some of the relevant changes to each of these categories. The first one was hybrid arrangements with a deduction, no inclusion outcome. So this is where you'd end up with the deduction in the US and no corresponding income in the non-US jurisdiction. The second category is disregarded payments under foreign law. So where there was a payment, but it was disregarded under the non-US tax jurisdiction. The third category were deemed branch payments. So that potentially can give rise to deductible payments, presumably when surrendered in a foreign group. Payments to reverse hybrids, so those payments from a U.S. company to a entity that is treated as a corporation, typically for U.S. tax purposes, but pass through for foreign, and then branch mismatch payments. So maybe we start with the first one, the hybrid arrangements with the deduction, no inclusion. Any specific things that you wanted to call out, Neil? Obviously, a number of changes, and like we've seen with a number of these reg packages, a lot of discussion related to commentary that was received and explaining why certain things were not changed and while certain things were.
Yeah, I mean, I think we've already mentioned the interest-free loan addition, right, which was a significant extension of the provision from what was there previously, although it's been kind of possibly as a clarification. But the other kind of area where there's been some changes is around timing mismatches, and this was something which was reasonably subject to a number of comments that were received as well, as to what extent is a situation whereby the US gives a deduction, but the foreign territory does tax the income, it just doesn't tax it till much later. Should that be within scope of the rules or not? And they confirmed that kind of some aspects of the existing rule where essentially more than a 3-year deferral is problematic, that's retained. But then have also introduced some rules around situations where there's like a character difference. The US is would keep causing a timing mismatch. So like the US is viewing a certain payment as maybe interest or maybe principal or some combination, and the foreign territory thinks it's a return of principal to start with, but they maybe tax the interest at the back end. There have been some changes in that area to try and make sure that as long as you are essentially taxing the income within what is thought of as a reasonable period of time, you're not within scope of these rules. But if there is a significant time delay, then even though you ultimately pay tax overseas, that's still caught.
Yeah, and that is a 36-month rule, correct?
Right.
For 3 years.
That's it.
One of the other things that there was quite a bit of commentary that I think is worth pointing out was whether there should be an exception for payments that were subject to U.S. withholding tax. And so I know a number of commentators, with the view that, well, if it's subject to U.S. withholding tax, the U.S. is already grabbing that tax, if you will, out the door. But what did Treasury say in response to that particular request?
Yeah, that was a pretty clear no, unfortunately, Doug. So the imposition of U.S. withholding, even if it's at the full 30% rate with any treaty benefits, it's not relevant in saying that the income has not been subject to tax, which is obviously unfortunate for companies in that situation where they pay the full 30% and then effectively don't get a deduction for the payment.
Yeah, and I think Treasury's view was just based on the statutory language that they just did not feel like they had authority to go that extra step, which obviously can result in double taxation. And I think a number of taxpayers are understandably concerned with that. And maybe there could be a technical correction or something like that in the future. You had mentioned the interest-free loans as well. I know there was some commentary and question about the effective date of that. So I believe that can you remind me, is that those are for tax years beginning after um, December 20th, 2018, I believe?
Yeah, that's right. So for taxpayers subject to the final regs, it's basically years beginning after the original publication date of the proposed regulations. The rules do also make clear that to the extent the foreign deduction was in any earlier period, then that's not subject to the rules. So for example, even if you had a US deduction in 19, but it related to an amount that had accrued in 18 in the foreign jurisdiction and been deducted in 18 in the foreign jurisdiction, that's generally okay. But certainly amounts accruing after 19 are within scope of the final rules.
All right, so let's turn to the imported mismatch rule, and I think you did a really nice job, Neil, explaining what that is. The way simplistically I think about it is it's really a back-to-back rule. So to the extent that the U.S. is making a payment of interest or royalties, makes a payment to then makes an on payment, that's when these imported mismatch rules can apply. So one of the things that I think is really important is that generally that imported mismatch, any amount under the mismatch is reduced to the extent that it is subject to tax under subpart F, either as actual subpart F or as guilty. So one way to manage the double tax, and that was one of the reasons that I brought up the withholding tax point, is that you can end up with double tax and withholding tax point, but they at least provided for a backstop if there's guilty or sub F to not have double tax. I know that, for example, there were some changes to the funding rule, also payments to territories with anti-hybrid rules. But can you talk a little bit about, Neil, about the imported mismatch rule and some of the changes we saw in the final regs?
Yeah, sure. And I think that latter point you mentioned is really quite a useful change. So what the way the imported mismatch rules work, as you generally said, is you've got to look for these essentially back-to-back arrangements, but there are a series of pretty complicated funding rules in order to tell you what back-to-back means. And so, it's not just the case of if the US makes a payment to company A, you have to look as to whether company A is making payments to company B. But if you've got that, you've also got to trace through and see, well, is B making payments to C and C to D? And what happens if A is making 4 payments to 4 different companies? How do you allocate and trace those payments? All of that is really quite complex. And one of the ways that Treasury has helped taxpayers with the final regs is to say that in my example, if company A is a territory which has adopted its own version of the anti-hybrid rules based on the Action 2 OECD paper, then you don't necessarily have to go and test all of its payments to all of those different companies. You can basically stop and say, well, those rules should have policed the appropriate deductibility of payments at that level, and so we can kind of rely on that. Now, that's subject to essentially 3 key exceptions, because obviously, back to some of the points we discussed earlier, the US rules don't align 100% with the OECD design. So what you have to do is still overlay the possibility that you might have interest-free loans or notional interest deductions, or certain other types of inclusion. So it's not you can't just totally stop there, but I think it is helpful in reducing the amount of testing you need to do and focus them on certain types of arrangements.
All right, so one of the other things that I thought was interesting was the notional interest deduction rules and the changes to the final regulations. One of the things that many of us that practice U.S. outbound taxation was a glitch in the regulations that would have appeared to apply the NID potential deduction for purposes of determining, or the NID rule, the NID anti-hybrid rule for purposes of determining whether you had a guilty deduction. And that issue was clarified and fixed in the final regs, I think, as a welcome fix to many U.S. multinationals that were struggling with the interpretation, and particularly where, if income was subject to guilty or sub F, we did not think the rules would otherwise be implicated. But can you talk a little bit about that, and then any other highlights or lowlights from the notional interest deduction portion of the reg package?
Yeah, sure. So I mean, I think it was generally very useful the way the Treasury have responded to some comments around those types of glitches, and the general philosophy back from the proposed regs was that if you were making a payment to an entity and that entity's income was getting picked up under subpart F or guilty, then the US didn't need another bite at that cherry. We were already including that income, and you're right. There were some questions around whether those rules really worked effectively in certain contexts, especially when you got into imported mismatches, and they did clarify that. So I think whilst you can't totally say you could never have an issue as a US multinational under these rules, this is predominantly a kind of inbound targeted set of rules, and it mostly works effectively in order to make sure that there's a broad set of exclusions that mean that typically you're not going to have a problem for those kind of US MNCs. And then the other change around notional interest deductions, and as I said earlier, this is one of those provisions where the US has decided to extend its scope on hybrids compared with the international consensus. But there was a small narrowing that consistent with the general scope of these rules is that they're looking to target deduction non-inclusion arrangements, not just those involving hybridity, but those where the deduction non-inclusion is caused by the hybridity. And so that's what they did with the notional interest deduction. They've said that if you're making a payment to an entity that benefits from the NID, then what you've got to do is look to the shareholder of the company that has the NID and say, well, if it actually had lent money to the NID company, would it be taxed on the interest income? If the answer is yes, then you have a hybrid problem. If the answer is no, then actually maybe you don't have a hybrid problem because maybe that entity is resident in a territory which just doesn't tax foreign income or something similar. And so that's designed to not be within scope of the rules because it's not hybridity that's causing the non-taxation. It's something else.
Helpful. So deemed branch payments, could you describe and remind our listeners what a deemed branch payments in and any major highlights related to the final reg package on deemed branch payments?
Yeah, I don't think there are too many major changes in this area, but just to put in context what this rule is targeting. So this is situations maybe where you have a branch, whether that's a US branch of a foreign company or through the imported mismatch rules, a foreign branch of a different foreign company. And under the branch rules, a deduction is being given for some essential like notional payment to the head office, right? It's not going to be a real payment because it's between the left hand and the right hand of the same legal entity. But in some jurisdictions, there may well be deductions given for those types of notional payments. What this rule is looking to do is to say, well, it's not appropriate to give that deemed deduction if the head office jurisdiction is not taxing the deemed equivalent deemed inclusion. So that rule was in the OECD branch paper, it was in the proposed regs, and it's largely followed through into these final regs too.
Yeah, and I think that we could say the same for payments to reverse hybrids as well. So, in other words, payment to an entity that we treated as a corporation for let's say U.S. tax purposes that otherwise would be subject to tax, and that is transparent for local purposes. There was a change to the definition of a fiscally transparent entity. Can you talk a little bit about that?
Yeah, sure. So, and this is important to this definition of what is a reverse hybrid. So, the way the regs specifically define it is an entity that is fiscally transparent under the law of which it is formed. So, for example, many partnerships that would be, their income is taxed to the members of the partnership, not to the partnership itself in many jurisdictions. So the reverse hybrid rules would apply where you have both that taking place, but you also have investors that are not including the income. So in other words, you have a mismatch that falls between the two countries. The definition of reverse hybrid was reasonably consistent with the description you gave earlier, Doug, and the way most people would think about how how these types of mismatches might arise, it's because of this classification difference in how an entity is viewed from Territory 1 to Territory 2. But the definitions actually in the final regs somewhat expanded that scope of the rule. And it looks like these sort of changes were aimed at certain collective investment scheme type arrangements, but they could be much, much broader than that in application. And the rules are broadened to say that you can be fiscally transparent as regards certain items of income, even if you're not generally fiscally transparent. And that might happen where some items of income are not taxed on a company, but they're intended to be taxed on the investors, but that's not true as regards all income or as regards how the entity is generally defined. And so that changes came in. It's particularly relevant in collective investment scheme and fund structures that are pretty common, but it could be much broader as well. And I think there's some challenging interpretations on whether the way that rule has been drafted is somewhat kind of overreached versus maybe what the intended scope was, and it'd be good if there was some clarification in that area.
Yeah, I agree, Neil. I think that would be something that taxpayers would very much view as helpful. Along those lines, maybe this is the last thing before we turn to the anti-conduit rules, but one of the things that was helpful for taxpayers as part of the reg package was the narrowing of interest, the definition of interest. And I think there's been a trend, particularly with 163J, as far as expanding the scope of definition of interest. But how did the 267 Cap A rules change the definition of what they define as interest for purposes of these rules?
Yeah, so the proposed 267 Cap A regs actually came out shortly after the 163J regs, and the original approach there was to a large extent mirror approaches, which in of itself makes sense, right? To be at least consistent between all of these different rules as to what we mean by interest. But those original definitions, when you look at it combined with what they call a structured arrangement, covered not just items that we would normally view as interest, or under kind of US tax principles, but also all sorts of other arrangements, like some cases like the hedging costs and other payments, could all be viewed as part of a single financing arrangement and brought within scope of these rules. What the final regs said was, in response to some comments, and particularly comments around the proposed 163J regs, where they took a similar approach, as you said, Treasury decided to end up with a much narrower definition. And so now what is interest is basically things that we've always thought were interest under US tax principles. But the broader definition of kind of other transactions has been dropped. So I think that'll be a welcome change, in order to protect against the possibility that the companies try to structure arrangements so as to benefit from that narrow definition. The change is accompanied by an anti-avoidance rule that essentially says, if you enter into one of those types of transactions, which is effectively a interest-like transaction, with a principal purpose of trying to get outside the hybrid rules, then you get dragged back in. So companies are going to have to consider that for any of these types of arrangements. But I still think it's probably a welcome change to have seriously reduced that laundry list. And the other piece is the final regs are not explicit on this point, but the linkage to the commentary around 163J and the fact the rules were similar in the first place, and this change was in response to comments on that reg package, is kind of potentially suggesting that the 163J regs, when we get to see the final version of those, could have similarly narrowed. And so that's certainly something to watch out for in the future when we see those regs.
And we'll be talking about it here on Cross-Border Tax Talks when those reg packages finally get dropped. I know a number of our listeners, including myself, are anxiously awaiting those 163J regs, amongst others. All right, so Neil, in the last few minutes here, I want to talk about the anti-conduit regs under Section 881. So these are proposed regulations. You did a very nice job at the top of the podcast kind of framing what Section 881 and these anti-conduit rules are. How did they change, and what should taxpayers be mindful of as they're investing through the U.S. or lending into the U.S. with respect to these rules?
Yeah, so the change was actually relatively narrow, and I think it largely ties back into this notional interest deduction um, regime that we talked about a few minutes ago. So the way the conduit rules work in principle, as I explained, was if a company was going to, let's say, lend into the US and it would benefit from no treaty relief or some amount of interest withholding that was greater than zero under the relevant treaty. If it tries to structure this arrangement so instead it lends to another country, maybe in a better treaty jurisdiction that then lends to the US, then like I said, sometimes these treaty benefits can be denied and the loan is viewed as a direct loan. In order to help scope that rule and understand when you have this type back-to-back type situation, that the conduit rules have got a series of rules that define essentially back-to-back financing and what constitutes financing in this context. And so what they did, partly in response to this NID point, was to say, even though you might not have what is traditionally thought of as a financing arrangement from country A to country B, if it is actually in the form of a regular equity investment from A into B, but structured such that B gets a tax deduction on that equity, and so the NID might be a good example, but not the only example where that would take place, then that equity is viewed as a financing transaction in the same way that just a regular loan would be. And so as a consequence, you potentially have to trace back to the original provider of the equity and test whether they would be in a good treaty jurisdiction or not, or otherwise fall within the conduit rules. So I think the key here is just to be aware of financing arrangements and understand whether there are any of these deduction for equity type situations within the group. If they are, you're going to have to trace through and think about the possible application of the conduit rules to them.
Yeah, and those proposed rules are effective after the regs are finalized. But I think that's great advice, Neil, and maybe we'll leave it there for particularly for the anti-conduit rules for companies to kind of go through those inbound companies in the U.S., looking through their structures, identifying where they may be getting some deductions on equity, and think about how that traces through the entire system. I think that those rules, along with the 267 Cap A rules, an extraordinarily complicated set of regulations. And it's going to be very interesting to see how the OECD and other jurisdictions continue to evolve with these rules. We're still waiting some of the other jurisdictions, as I mentioned, in Europe to final their rules. And I'll be interested to see how they compare where we started this between the UK rules, the Australia rules, the US rules, compared to the original OECD guidance. And it's just a very complicated area as we think about cross-border financing for taxpayers to be aware of. So, Neil, thank you very much. And thanks for tuning in to this week's Work From Home episode of Cross-Border Tax Talks. Thanks again to Neil Edwards for joining me on the podcast. I'm Doug McHoney, PwC's International Tax Services Leader. You can follow me on Twitter at XBorderTax. Stay tuned in 2 weeks for another exciting edition of the Cross Border Tax Talks podcast.